Hello everyone, Leo Jr. over here at Gem Young Insurance, coming at you with my first Insurance Simplified video. I like to make my videos based on what my clients ask me, and one of the most commonly misunderstood parts of insurance that we see is life insurance. So today's video, Life Insurance 101, is designed to help you understand the basics of life insurance, the different types, how it works, what it does, and what happens after you sign that application and the process goes from there. Everybody seems to have a better grip on, for instance, home and auto insurance or business auto and business insurance, since that's required. Life insurance is one of the insurance aspects that's not required, but it is the cornerstone of any good financial plan. We work with an in-house team of financial advisors, so I speak a little differently, and I would tell you that our job at my company is the insurance company protects your assets. The wealth company grows your assets. This is a means of protecting your assets from one generation to another. That's the core of life insurance. When you die, life insurance will pay your beneficiaries a certain dollar amount to settle everything that you left behind so that their standard of living doesn't change. Remember the principle of indemnity, right? Which nobody knows that, right? That's some insurance lingo that my industry has done a very poor job of explaining. So indemnity is putting you in the position you were in right before that claim happened. Again, Insurance Simplified, you're not going to hear a book definition out of me. So you have an auto accident, right? Your auto policy takes you, pays you what we need to do to fix your car, heal your body, fix other people's stuff, put you in the position you were in before a claim happened. Life insurance does that with your family or your business. It takes this need that you need to protect, your debt, your children, whatever, your estate, and we put them in the position you're in before using a life insurance contract. So that's what life insurance does at its core. Now, I said the word beneficiaries, right? Life insurance has what's called beneficiaries. It's pretty self-explanatory, but what that means is beneficiaries are the people that directly benefit from the proceeds of your life insurance. For example, your spouse and your children, your business partner, business partners. So if you have a family and you have 3 children and God forbid something happens to you, we would list your surviving spouse as what's called a primary beneficiary, and this is someone that gets paid first. Now this isn't standard advice across the board, this is just an example for the video, right? So we list your spouse as primary and we list your children as contingent. Contingent means if something happens to primary, we're paying the contingent, so the kids. Again, just an example. So beneficiaries are the people that directly benefit. Same thing is true for a business. If you passed away, for instance, we have what's called a buy-sell agreement in business where we would fund that using life insurance, meaning that if you died, your business partners would have to have the proceeds to buy out your partner, spouse, whoever, right? Or whoever would inherit your share of the business. Depending on how your business is structured, that's a whole nother video, buy, sell, all that other stuff. We'll get to that. So there's 2 different types of life insurance. There's what's called permanent life insurance, and there's what's called term life insurance. Term life insurance is a temporary policy to cover a temporary need, right? So let's break that down for a second. What's a temporary need you can think of in your life? The most common one that I see is raising children or business debt or a mortgage. Those are the big ones we see. So, right, you don't have a mortgage forever. You're not going to pay on that for the rest of your life. You might have a 20, 30-year mortgage. So when we consult with clients that take on a lot of debt, we provide a temporary policy to cover that debt until the debt's paid off. Same thing with raising children. It doesn't cost you the same to raise your children at ages 8 through 12 as it does through age 25 through 30. You know, they're financially independent, they're on their own. There's different standards, there's different needs. So we oftentimes advise young parents to buy term insurance because it's less expensive than permanent insurance. And you can get a big bucket of money and rent it essentially for 20, 30 years. Permanent insurance, on the other side, is something that's designed to be with you for your entire life. Those are things like whole life or universal life. Depending on your needs and depending on what your goals are will depend on the type of policy that your advisor will help you pick. And this is one of those things where I would absolutely recommend talking to an advisor because he or she will help you drill down to what your needs really are and advise you on the right product. The longer you watch this video, the more you'll see that life insurance is complicated. You know, the point is to make it a little bit simpler for you. So let's recap real fast. What is life insurance? Life insurance is a vehicle of asset protection and protecting your financial plan to make sure that your wealth and assets get passed down from your generation to the next, or that your spouse could be living in the same financial position you guys were in before you died. Life insurance has beneficiaries, which are the people that get paid when you file a claim on that policy when somebody dies, right? And there's two different types, permanent and term. Permanent is a life insurance policy designed to be with you for your whole life, universal life and whole life. And term insurance is just that, a temporary policy for a temporary need. So let's move on, right? What's a couple of features of universal life and term, and what's the different types, right? So term insurance is pretty much term insurance, right? There's a regular term policy, I would call it a standard term, where you just pay into it each month, the price never changes, and the coverage never changes. And at the end of 20 years, it's over. We'll get into conversion options later. Or there's another type of term called a ROP, or return of premium. A ROP is what we find to be really, really good for business owners and young parents. Here's why. ROP in life insurance, like I just said, means return of premium. So after your term is over, typically again, 20 years, the life insurance company will give you all of your premium back. I'm going to pause there because I said exactly what I said. I know, it's kind of wild, right? What they'll do is let's say you spend $1,200 a year on a term policy and you're a young parent, right? And in 20 years, your kids are out of school. You can use that $1,200 a year, add it up over 20 years, and the life insurance company will write you a check for that amount after 20 years is over. You can use a ROP as a deferred savings account. Again, we'll get into the life insurance strategies later, but there's cool things with term. With term policies, at the end of them, there's what's called a conversion option. On most of them, again, sidebar for a different video, what makes or breaks a good term policy isn't just the price and the coverage, but it's the quality of the contract and your conversion options at the end. Cheaper isn't always better with life insurance. Conversion means you can take that term and make it a whole life without going through a medical evaluation again. A feature of term insurance. So pretty much what the life insurance company says is, you bought a term policy with us 20 years ago. We're going to take you on your word that you're still healthy, waive that requirement, and provide you with a whole life policy or another type of policy depending on the company for whatever value that you're agreed to. Being vague there on purpose because conversion options are very different with every company. Before you buy term insurance, definitely check the conversion options. If you take nothing from this video, that's an incredibly important part of this. So term insurance, that's some of the points over there. You can either rent it for 20 years and give it up completely. You can get one with a little more features and convert it, or you can get one that acts as a deferred savings account called a ROP or return of premium and receive all of your premium back at the end of the term period. Now the life insurance company will invest that money, so don't worry, they're making their money on that too. Now the other type, permanent insurance, right? It's there as long as premiums are paid, it's supposed to last for your entire life, right? That's what its purpose is. Now they don't always do that. And that depends on your strategy, and that's not necessarily a bad thing. With permanent insurance, there's two main types, whole life and universal life. Whole life is a guaranteed permanent policy that as long as the premiums are paid, it will always be there. It's set in stone and you can never change it. It offers unparalleled guarantees and security, which is an incredibly good thing with life insurance. You never want to get frisky, you never want to get weird with your life insurance, right? Don't take too many gambles, because I said in the beginning of the video, this is the cornerstone of your financial plan. So whole life, for instance, if you take out a $100,000 whole life and it's $100 a month, it will be $100 a month for the rest of your life, as long as you pay it. You can't change the coverage, you can't change the premium. You can change the beneficiaries, however. Now, universal life is whole life with the flexibility. So it's a policy that's designed to last you for a certain period of time. Not always your whole life, but it can. And it provides you a little more flexibility, but at the same time, a little more risk. Universal life is typically less expensive than whole life because it's not guaranteed. That's not necessarily a bad thing depending on your situation, but again, your advisor should help you through that. One of the big differences between a universal life and a whole life versus a term policy is a universal life and a whole life build what's called cash value. I made a short video a couple of weeks ago on cash value, but essentially what it is it's the leftover premium in your policy. I'm going to put a little graphic up here at some point. You'll see it. It shows how cash value works. But essentially, to put it to you in layman's terms, we overcharge you with life insurance when you're young. People don't know that, but we do. And we take that and we put it into a little fund called cash value. With life insurance, specifically universal life, the pricing model increases every single year, right? So we overcharge you in the beginning to undercharge you later on. The gamble that some people make is that they keep this cash value for themselves when they get to be older in life, and maybe they don't need life insurance anymore. Maybe they do. I know that's a lot throwing at you, but let's recap. Term insurance, you rent for a period of time, and you can get your premium back on certain policies. There's conversion options to pay attention to. Permanent insurance is whole life and universal life, and depending on the guaranteed or non-guaranteed option you pick will depend on your strategy. The big difference between those two is permanent builds what's called cash value that you can borrow against, that you can surrender the policy for and take, or you can use to pay premium in the future. And on term insurance, no cash value. Follow me so far? Awesome. So within those policies, there's what's called riders. Riders in life insurance is a modification to your policy that lasts for either the entire policy or a certain period of time. Think of a rider as literally a cowboy riding a horse, right? Your horse is your life insurance policy, and it's just riding along, right? And your rider jumps on and he picks up a passenger, right? And the passenger rides for 20, 30 miles, years, and then the passenger gets off somewhere and you ride the horse farther, right? Your passenger is your riders and your rider. A rider example, this might help, is a children's term rider or a long-term care rider. One rider stays on the policy forever and one lasts just a little bit of time. The children's term rider, for instance, is a rider that your parents can put on a policy that would protect a child until a certain age. So both spouses have a universal life policy and they have 2 kids, right? Let's say policy over here for this spouse has 2 children's term riders for $20,000 each. The children will reach a certain age, let's say 20, and the life insurance company says, okay, they're done. You can convert these or they have to go away. We'll get into complexities of riders later. The long-term care rider, for instance, the life insurance company will say, okay, this is on the policy from the beginning of the policy all the way till the end or a claim is paid. Different types of riders last for different periods of time. I picked those 2 riders because those are the 2 most common ones we see. I will make a whole nother video just on riders at some point. So that's why I'm kind of glossing over a little bit of the details there. But again, to recap, a rider is a modification to a life insurance policy that lasts for a specified period of time or the entire policy depending on the rider, the company, and the details. So at this point, we've covered what life insurance does, what it is, the different types of it, how beneficiaries work, some riders, and some features of each type. How do you know which one's right for you? That's what this video is all about, right? The truth is, everybody's situation is a little bit unique. I've heard this quote directly from my dad, and I'll pass it on to all of you. Life insurance, where people go wrong with life insurance, is it's usually a poor application of the right product. So the reason that people like me have a job is to help guide you into getting the right life insurance so that it accurately protects you and reflects your needs. We do what's called a needs analysis internally, and that's an industry standard thing where you meet with your advisor and you talk to he or she about what your goals are, what your priorities are, what your budget is, and what your health looks like, and he or she will help you get your right life insurance. So let's say you have that needs analysis, and let's say you and your spouse or you and your business partners find the right life policy. What happens next? Life insurance is priced based on what's called rate classes, which is pretty much categories of your health, right? So for instance, the healthiest person out there is what we would call preferred plus or premier or elite or whatever, right? Every company's got a different word. And based on your health from there, you either go preferred, standard plus, preferred standard, standard tobacco, substandard. We break it down in categories, right? So you fill out a life insurance app. The life insurance company will call you for a phone interview. That particular company will then do what we call a script check or a background check on your medicine, figure out your diseases, if you have any, what medicines you take and what for, your hospitalization history, so on and so forth. You sign a HIPAA form to let the company do that. Then once they get a hold of that, they'll oftentimes send you for a medical evaluation, typically blood, urine, height, weight, and if the life insurance policy is big enough, sometimes an EKG. And then they take all this information and collect it together. right? And then they determine your rate class. Once they determine your rate class, they finalize your price. Now, someone like your advisor should be doing a lot of that up front. So at the time of application, or preferably during the needs analysis, your advisor is going to ask you things like, do you smoke? If you drink, how often do you drink? What's your medicine look like? Do you take medicine? And they'll use that to kind of pre-screen your health category so there's no surprises. Again, life insurance is priced based on health classes. Age is also a huge factor, as is gender. Sorry guys, ladies are less expensive to insure, just the way it is. We'll have another video on rate classes later. So the younger you are, the healthier you are, life is when life insurance is least expensive. So if you're ever going to find a time to buy it when you're young. Even if you don't quite need it yet, it might help save you cost in the long run. So that's how life insurance works. Once they figure out your rate class, they'll make you an offer. You choose to accept it or not and go from there. Naturally, if anybody has any questions or suggestions for a new video, please let me know. I appreciate you visiting my channel, and don't forget to like and subscribe. Thanks, everybody.